Good morning, everyone, and welcome to the Genus monthly webinar. Today's topic is how value-based investing works, and we will get started momentarily. My name is Sue Talbot, and I'm a partner and portfolio manager here at Genus, and I will be moderating today's session. Aligning your investments with your values has become more important and more complex than ever. And even with today's challenging markets, this conversation remains relevant. And many of you have asked us, how does value-based investing actually work? How do you decide on what companies to invest in? And how does it compare with traditional investing? And of course, the big question always is, do I need to sacrifice returns to do it? So today we're going to cover as much as we can on this rather large topic. And we're going to provide some definitions on key terminology like ESG and sustainable and impact investing. We'll also explain how we decide which stocks to include or exclude from our sustainable impact funds. And then we'll also give you some examples of value-aligned investments and the impact they have in the real world. And I'm happy to have with me today for this discussion our very own Mike Thiessen. Mike is our Chief Sustainability Officer here at Genus, and he also serves as our co-CIO. Our LinkedIn profiles should be in the chat now, and we'd love to connect with you there. So while we're waiting for a few more people to log in, let's take care of a few housekeeping items. To maximize your screen for the best viewing experience, you can click on the icon on the top right of the screen. It's the one with the arrows. And as I mentioned, please type your questions in the chat at any time, and we're going to spend some time today answering your questions. And if you're finding you're having technical trouble, you can also let us know through the chat as well. And we do have somebody on hand to try and assist. And one great solution we find that usually works is to hop off and then come back in the room. And that sometimes solves the problem for you. So I'd like to start off by extending my gratitude to the Indigenous peoples, specifically the Coast Salish, Tsleil-Waututh, Squamish, and Musqueam, whose lands I am honored to speak to you today. We do this to reaffirm our commitment and responsibility in improving relationships between nations and our understanding of local Indigenous peoples and their cultures. Canada is home to Indigenous people from across Turtle Island, and we're grateful to have the opportunity to meet and work on this territory. A note that while we recognize that everybody's investment journey is unique, we hope we can provide some key takeaways for you today that you can bring to your own experience. For those of you who are new, those of you who are new to Genus, we've been managing sustainable investments for over 20 years. So we've been doing this for a long time, and we have a long, solid track record in this space. And we'd like to say we've been doing this type of investing before it was cool. Today, all of our investments at Genus are viewed through an environmental, social, and governance lens. So although we've been dealing with pretty challenging markets for the past few months, that doesn't mean we can't focus on ESG issues or environmental, social, and governance issues within our investments. In fact, investors and regulators worldwide are demanding more transparency around these issues. And now companies and governments are required to report this information in their annual reports and disclosures to shareholders. So Mike will touch on the Genus perspective in his portion of the webinar. So we're going to get started, and we're going to start off with a poll. So our first poll is just to confirm where our viewers are at on this topic. And if you click on the poll tab at the right there, hopefully the poll will come up. Okay, so you see it there. So the question is, what level of experience do you have with value-based investing? And you can
So I'm not sure if I'm the only one that can't see Sue, but I'm not able to see Sue at the moment. So we can continue with the poll. So I'm looking at the poll right now. It looks like 11% are saying very experienced, 66% say some experience, and then 23% say no experience. Oh, and there's a few more coming in, but it looks like the results are somewhat similar still. So most people have some experience when it comes to values-based investing, so that's good. And then about 24% have no experience so far. But we'll talk through this and give some thoughts for all different levels when it comes to values-based investing. So we'll wait a little bit here, see if Sue reconnects.
Hi, everyone. Sorry about that. So I am back. Panic time. Okay. So, Mike, where are we? Did we finish
so
with the poll?
so we talked about the results from the poll.
Okay, great. So some experience looks like the winner there at 61%. Okay, so it looks like we have a wide level of experience in the room. So we may not be able to answer everyone's questions today, but at least hopefully we can provide you with some of the information that you're looking for. But if we can't answer your question, you can please connect with your portfolio manager to continue the conversation. And if you're new to Genus, you can also reach out to a portfolio manager via the Teams page at our website at genuscap.com. So thanks everyone for your answers. And now we're going to move to poll number 2. And the question should be coming up momentarily. But the question for poll number 2 is, what do you want to get out of this webinar? And if you can please type your comments in the chat, that would be helpful. Okay, so far, no answers in the chat. So again, the question is, what do you want to get out of this webinar? Okay, is it just me, Mike, or is there no one else? Okay, thank you. The answers are just starting to come in. So understanding how to identify values and invest around them, elementary understanding, review of FF definitions and how to measure performance, more info on how Genus chooses stocks, some insights into the value-based investing, and what are the values, for instance. Okay, great. So thank you, everybody, for those answers. And I'm happy to say that we will be addressing most of those questions in our presentation. So that's perfect. Thank you very much. Okay, so we're going to move on to the presentation now. So for a lot of us, our values dictate many of our day-to-day decisions. So should our values also influence our investment decisions as well? Value-based investing is a relatively new concept in the wealth management circles. So nobody was really talking about this 6 or 7 years ago, but now it's on everybody's radar. So today in my section, I will be giving the portfolio manager perspective on how we help clients determine their values and how we work together to come up with a strategy that aligns with both their values and their investment objectives as well. So many people believe they can make a difference with their investment by avoiding companies with practices that they don't support and focusing on those that take responsibility. So this belief is the basis for socially responsible or values-based investing. So what is driving people to responsible investments and what are they most concerned about? Well, there's probably 2 reasons. For the most part, investors want to divest for values reasons or values alignment. So as an investor, when you're investing in a company, you are essentially financing that company. So if you're concerned about the environment, then you probably shouldn't be owning a fossil fuel company. So investors are divesting for values reasons. But many investors also divest for financial reasons as well, and that's to avoid investment risk. So products that are more likely to hurt people or the environment are open to more risks, and these are not clearly visible on companies' balance sheets. So other risks could be things like cultural backlash, taxes, regulation, and litigation. So we've seen this happen with tobacco, and of course we're also seeing this start to happen with fossil fuels as well. So less demand for products and services will eventually hit the company's stock price. So that's not a viable business model to have, to produce harmful products and services. So in this case, investors are divesting for financial reasons or to avoid investment risk. And at Genus, we look at both of these concerns in our risk analysis and stock selection process. But today we're going to be focusing on the values portion of the equation. So responsible investing or value-based investing is done when you consider ESG factors in your investment decision-making process. And I know there's a lot of people in this room who are very familiar with this acronym, but for those that are new to value-based investing, let me introduce you to ESG considerations, or environmental, social, and governance considerations. So no surprise, there's been a lot of focus on E, or the environmental factors. Climate change is one of our biggest challenges that we're facing, so that makes a lot of sense. And a couple of important concerns are things like pollution, waste management, and deforestation. However, we're starting to see a shift now towards more of the S and G, or the social and governance factors. And this is probably due to the pandemic, which has really highlighted racial injustice and also social and economic inequality in our societies and workplaces. So what are some of the S&G considerations for investors? So examples of social considerations may be looking at worker safety, labor standards, and impact on local communities. Governance considerations may be board composition, both gender and ethnic, and things like executive compensation and business ethics as well. Why is it important to align your values with your investments? Well, aside from wanting to avoid harm and do good, there's a number of other reasons as well. And the most important, I think, is now you're more engaged and informed as an investor. So now you understand the investment strategy better. You want to review the portfolio holdings, and you may want more information on some of the specific companies and names in your portfolio. So this definitely makes you more engaged and informed. And another important reason is when you add values to the mix, the legacy now goes beyond you and your family and contributes to making a lasting difference to the world. So now let's take a look at what I call the values spectrum. Today, there's a lot of terminology thrown at us. There's responsible investing, sustainable investing, impact investing. So what do these all mean? Do they all mean the same thing? And a lot of us do think that these terms are interchangeable, but they do in fact refer to different strategies. So let's take a closer look at these numerous categories. So let's start on the far left there. There is regular investing, or traditional investing. And here you don't consider ESG factors. You're not looking at environmental, social, and governance factors here. The focus is on maximizing return. And to the right of that is responsible investing. And I call this light green. So here you are considering ESG factors, but only if it's beneficial to do so. So you're using ESG considerations to better manage risk and improve returns. And this is less about values alignment, but more about risk management. And shareholder engagement is also used in this category as well. So shareholder engagement is where shareholders and stakeholders engage with the company to try and change corporate behavior or advance an issue. And there's been a lot of success stories with shareholder engagement. Genus does use shareholder engagement across all our investments. And in Mike's portion of his presentation, he's going to give you some examples of what we've done in the past. Next is socially responsible investing. And this is where you're divesting from specific products and services. And this is based on values or ethics. And we also call this negative screening. So here you're gonna draw a line and you're gonna say, okay, I'm gonna invest in this and I won't invest in that. So avoiding things like fossil fuels or weapons as an example. So here you're achieving values alignment. And shareholder engagement is used here as well. Moving further along the spectrum, you get to impact investing. So this is where you're going to achieve specific values alignment. So here you're going to pick and choose which themes you want to support. So themes like clean energy, climate action, good health and well-being are some examples. And this is where we apply positive screens, as they call it. And you're looking for specific themes to invest in. You're wanting to make that environmental and social impact. And the impact also needs to be measurable. And at Genus, we make sure that all our impact holdings align with at least one of the UN SDGs, one of the United Nations Sustainable Development Goals. And Mike will get into the details in his section on how we pick specific names and how that impact is measured. And under the impact section, you're going to see two categories here. So the first one is what we call liquid impact. And this is investing in marketable securities. So marketable securities are stocks that trade on major exchanges and they're priced daily. So they're very liquid, meaning that you can sell them at any time. The last category is illiquid impact, what we call illiquid. And this is where you're investing in private debt or private equity or venture capital with an impact focus. So here you can be really specific about what you want to support, like investing in a solar company that's privately held as an example. So since these type of investments don't trade on a public exchange, you really need to make sure that any additional investment risk aligns with your investment objectives as well. So at the end of the day, we all have unique values and priorities. So it's important for us to understand what the choices are out there for us. So how do we get started on an action plan? Well, the first step is to identify your priorities. And as I said, everyone is different. Everyone has unique values and priorities. So what is most important to you? Do you want your investments to be consistent with your ethical beliefs? Do you want to avoid certain companies or sectors and invest in the rest? Or are you more focused on impact? You're looking for companies that provide solutions to environmental or societal challenges. Or is the focus on maximizing returns? Most likely, it's going to be a combination or a blend of all three of these objectives. So this is where you work with your portfolio manager on a customized solution to make sure that your goals can be met. So next is coming up with a plan that integrates both your values and your financial goals. So step one is to answer all those regular, normal financial questions. At the end of the day, we all have financial goals that we need to meet. We may want to own a home, we may want to travel, fund our retirement, or leave an inheritance. So in order for us to determine your financial objectives and your risk profile, we need to address the following. Time horizon. So this is time horizon of your funds, not of you, the person. And people often get this confused. So a young person still can have a short-term time horizon if they need the money for a down payment in 3 years, as an example. Or a retired person can still have a long-term time horizon if the funds are required to sustain them for the rest of their lives. So other things that need to be addressed are income requirements. Do we need to focus on generating income for you? What is your risk tolerance? And that means both financial risk tolerance and emotional risk tolerance. So financial risk tolerance is the financial ability to ride out any short-term market fluctuations. So any downside is not going to materially affect your lifestyle. Emotional risk tolerance is much different. So even if you have the financial ability to ride out any downturns, but you hate seeing your portfolio value fluctuate and you're losing sleep at night. So emotional risk tolerance also needs to be addressed as well. What are your return expectations? Is it to keep ahead of inflation, or do you want to earn 20% a year? In that case, that probably is an unrealistic expectation. And are there other unique circumstances we need to be aware of? Are you expecting an inheritance? Or are you holding securities with a low cost base you don't want to sell for tax reasons? And the next step is to identify your values objectives. So again, where are you on that value spectrum? Do you want to simply avoid certain products and services using that negative screen? Or are you looking to make a specific and measurable impact with your portfolio? Are you wanting to invest in companies that are making a positive difference, both environmentally and socially? Do you want to have greater values alignment by investing in a specific startup or venture capital company? Or would you like to make that specific impact by donating directly to that charitable organization? So again, it's going to be the job of your portfolio manager to work with you to make sure that both your values-based goals align with your financial goals as well. And sometimes they may not. So if you have high income requirements, or you need liquidity, or if you have low risk tolerance, then maybe your portfolio should not be heavily weighted in impact investments. And that's not to say you shouldn't have impact investments in your portfolio, but again, we need to find that right balance to make sure your financial objectives are met as well. And lastly, your goals, objectives, and constraints and unique circumstances need to be documented in an investment policy statement. So this is a written document that will allow you to assess if your objectives are being met. And your portfolio manager will review your circumstances annually with you to make sure that it is still relevant and that no changes are required to your strategy. So just to note that when we write the investment policy statement, it is written in mind with a long-term strategy. So the idea is not to be jumping in and out of strategies. That's probably not a good idea to do that. But obviously objectives change over time, and that is the reason why we need to document. We need to make sure that this document is reviewed on a regular basis. So now I'm going to hand it over to Mike, who will explain in greater detail the investment side of things and how we pick our values-aligned investments and the impact they have in the real world.
Great, thanks a lot, Sue. That was an excellent primer on values-based investing and why we do it, and the process of building your investment policy statement based on your values and your financial needs as well. So I'm going to go more into the values-based investing process, so how we create a portfolio, go into engagement, go into measurement as well. So one of the first things that we need to do when we're creating a values-based portfolio is we need to figure out what we are going to invest in and what we aren't going to invest in based on values. So we need to look at positive screens. So these are what the the different areas that we do want to invest in. And then we want to look at negative screens. So these are the different areas that we don't want to be investing in. Over the years, we've listened to clients and built up a list of positive and negative screens that we have for our funds. So in terms of positive screens, we try and have certain things within our portfolios. So we make sure that we have things like human rights and climate action and business ethics. In terms of negative screens, we have a list of a bunch of negative screens. So some of them include fossil fuels in our fossil-free funds. We cut out tobacco in all of our funds across Genus. We have other exclusions such as alcohol, GMO, weapons, nuclear. We have gambling. We have companies involved in widespread or severe controversies. So controversies around labor or community or the environment or the products they sell or governance. So we're trying to avoid those companies. We cut out companies that have high overall ESG risk. So the company might be negatively impacted by an ESG risk. And then we're also looking at carbon intensity. So how much carbon does the company have to emit per million in sales? So we're cutting out the really high carbon intensive companies. So these are the positive and negative screens. And this is actually the first part of our investment process, is figuring out these screens and then screening the investment universe. So we start off with about 2,000 of the largest cap stocks from around the world. And then we apply these screens. So we actually, through these screens, we go from 2,000 stocks down to about 1,300 stocks because that 700 don't pass these screens. So once we have our sustainable investment universe, then we move on to financial ranking. So we have quantitative models at Genus that rank companies based on their financial projections. So how well we think that they'll do in terms of performance in the future. So stocks are ranked from 0 to 100 within our models. And our models are based on things like growth, on value, momentum, expectations, sustainability. And they're back tested and analyzed. Typically, our back tests go back 10 years, sometimes 20 years, to really ensure that historically, at least, these models have performed very well. So historically, companies that have been ranked in the top, maybe the top 10%, have performed much better than the companies in the bottom 10% for our models. And then we overlay these financial models on the actual portfolio that we're looking at. So if the portfolio already has stocks within the portfolio, then we'll be cutting out companies that have low rankings, and then we'll be buying companies that have high rankings. And then we apply risk management and portfolio construction. So we're making sure that the sectors and geographies are aligned with where we want based on our macroeconomic models. That's kind of another area that we could explain maybe in the questions if we wanted to get into macro models. Then we also do our risk management measures. We have institutional style risk management at Genus. So we're looking at a variety of different metrics having to do with risk. We also have risk within our financial models as well. So in the end, we create our customized sustainable portfolio. So we start off with all the stocks in the universe. We cut out the companies that don't meet our values. And then we apply our financial models, and then we go on to risk management, and then we have our portfolio. So even once we have created this portfolio, that doesn't mean that our sustainable approach stays there. We're investing in companies that we think are really good, companies that are values-based, but there's always room for these companies to improve and get better. So that's where engagement comes into play. So engagement to us is very important. We want to really encourage these companies to improve in certain areas. And so we've actually teamed up with an expert organization called Share. So Share is a nonprofit group. They specialize in engagement and proxy voting with large corporations. So they have a large team of experts that focus on different areas of engagement. So with Share, we're actually able to really leverage our engagements more. They represent about 90 billion in assets, whereas Genus is just under 2 billion in assets. So they're able to have a lot more influence and sway on these large corporations than we would if it was just us going up to a corporation and wanting them to improve in a certain area. So we consult with Share throughout the year. We also have a big annual consultation where we're figuring out what our engagement plans are for this next year. so that our engagement values are aligned with shares as well. And we're saying yes and no to engagements throughout the year, kind of as we go. So in terms of engagements, there's a variety of different types of engagements that we do. So there are, it's saying that I might need to reconnect here. I am going to go out and come back in.
Hi, everyone. So obviously we're having connection issues this morning, so we'll wait for Mike to come back in. And I wish I could read this slide for you, but the text is so small. So we'll just wait for Mike to reconnect. Hopefully he'll be back shortly. Okay, so it looks like he's coming back. Great. Yeah, I think you were fine, Mike. We could still see you, but that's, yeah, welcome back.
Oh, really? Okay. Okay, great. Perfect. Slides cannot be seen properly, says one of the participants. Right now I can see the slides. I don't know if, okay, another person says they can. Okay, I'll keep going. Maybe you want to go out of Demio and then come back in. That's what I just did. And that could work for you. Okay, so in terms of engagements, there are a variety of different engagement types that we do. So some of the engagements are things like racial justice or political spending and oversight, reconciliation with Indigenous groups, climate change and reducing greenhouse gas emissions. So those are kind of the main ones. There's also other ones such as decent work or water security or civil rights as well. So if we dive deeper into climate change has been one of the big engagement focuses for us for the last few years. And within climate change, Canadian banks have been a big focus. So Canadian banks are in an interesting spot when it comes to climate change because they have the choice whether they want to lend to climate action solutions or they can lend to companies that have a negative impact on climate. So we find that this is a great area for us to engage because they can really choose where they're going to be focusing their business. And with our engagement, we can set into place, policies and procedures for these banks to make sure that they're investing more in the solutions than the negative impact areas. It's not like oil and gas or like tobacco, where their main product is a product that has negative impact. They can actually choose to get away from it. There's a lot of asset managers that will try and engage tobacco companies, will try and engage oil and gas companies, and they could have some small wins there, but it's very unlikely that those companies are going to drop their main product, drop their main source of revenue, and go into some other business line. But with banks, they can definitely change, they could definitely improve. And so we've had some significant commitments from Canadian banks in the past couple of years, which has been really exciting. So Canadian banks have adopted green finance principles. They've established high carbon exclusion policies so that they're not lending to really high carbon projects. And they've also set net zero 2050 commitments. And in the next couple of years, big focus for us is to have board level oversight for climate change among banks. So at the highest levels of leadership, they're focusing on climate change. And then also science-based targets when it comes to net zero for 2030 and for 2050 targets for banks. So we'll continue to engage them. In particular, we've been engaging Scotiabank. So with Scotiabank, we've had some big wins there, such as an agreement to accelerate the net zero transition. We've also had commitments by Scotia to show their lending approach, which is very important when it comes to sustainability, because we want to know what banks are lending towards, because we want to know what kind of impact they're making with this lending, and we want to know what risk they're taking on, because as Sue mentioned before, if you're lending towards businesses that are hurting the environment or hurting people, you're more open to particular risks such as litigation or increased taxes or regulation. or cultural backlash. So we want to know what risks that what risk we're taking on. And then Share and Genus as well have filed 2 shareholder proposals for Scotia to align with the Paris Agreement. So we're hoping that that goes through soon. Another focus for engagement has been reconciliation. So with reconciliation, we're wanting corporations to create strong proposals around their relationships with Indigenous communities. One of the areas of engagement is wanting them to align their Indigenous policies, at least with the UN DRIP. So the UN DRIP is the United Nations Declaration on Rights of Indigenous Peoples. And this declaration gives minimum standards for well-being and dignity for Indigenous people around the world. And so that's just kind of the bare minimum. So we want to make sure that companies are at least doing that bare minimum, hopefully a lot better than that. But we want them to be aligning their policy with the UN DRIP. And then we're also wanting companies to commit to certification under the Progressive Aboriginal Relations Program. So this is a certification where you can get certified as a good partner with Indigenous communities. You're certified as a good employer of Indigenous people, and you're also certified as a company that's committed to creating prosperity among Indigenous communities. So there's 3 companies that have committed through our engagement, 2 of them being Sun Life and Canada Life. And then there's 4 additional shareholder proposals that have been filed last year that we're waiting on. So we're wanting more companies to become certified under PAR. So when we create these portfolios, then we're engaging the companies within the portfolios, but we also want to measure how well we're doing in terms of sustainability. And we want to report this to clients as well. So clients get reports on the impact measurement, on the sustainability measurement of their portfolio. And so these are the main sustainable funds that we have at Genus and their sustainability metrics. So you can see that they're fossil-free, that the fossil-free funds have 0 fossil fuel reserves relative to their benchmark that has quite significant fossil fuel reserves. And then in terms of carbon intensity is the tons of CO2 per $1 million in sales. So you can see that the fossil-free funds have quite low carbon intensity relative to the benchmarks. And then when it comes to ESG ratings, we don't actually try and maximize ESG ratings. We're just trying to align the portfolios with our clients' values. But that tends to mean that we're either have the same ESG ratings as the benchmark or typically much higher than the benchmark. So you can see, especially there, the high impact equity fund in the middle has a much higher ESG rating than the benchmarks. Another area that we measure is impact. And impact is a relatively difficult area to measure. There are many impact measurement tools out there, but about 2 years ago, maybe 3 years ago now, we heard from a lot of clients that they wanted to have a measurement tool that was holistic. So measure both the positive impact that a company was making and the negative impact, because there's a lot of tools out there that just do positive. And they wanted to have a measurement tool that was relatively easy to understand and something that didn't have pages and pages of reporting that they needed to go through. So after listening to our clients, we decided to create the net impact score. So this is a score that is based on the United Nations Sustainable Development Goals. So those are 17 goals created by the United Nations in 2015. And they vary from things like good health and well-being, quality education, reducing inequalities, climate action. And so our net impact score takes into account the positive impact, negative impact, and then gives a net impact score for a certain company. And we can also do this for portfolios as well. So the way that we measure positive impact is we look at what percentage of revenue is being generated by a product or service that contributes to at least one sustainable development goal. So that could be a renewable energy company that is making 100% of its revenue through renewable energy. And that would be a 100% positive impact because all of the revenue is going towards contributing towards a sustainable development goal. But if there was a company that just had maybe 20% of its revenue focused on education, then that would be a 20% positive impact investment, because that 20% is going towards the quality education sustainable development goal. And then on the flip side, we measure negative impact in the same way. So we look at what percentage of revenue is detracting from a sustainable development goal. So maybe if 80% of a company's revenue is coming from tobacco sales, then that would be 80% negative impact, because 80% of the revenue is detracting from the good health and well-being sustainable development goal. So then we take the positive impact and negative impact, combine it to get an overall net impact score. And we can also get this for portfolios as well. So this score has actually won some awards in Canada and the US, just based on the simplicity, but also the holistic nature of the overall measurement tool. So if we look at our fossil-free Can Globe equity and fossil-free dividend equity, here we can see that the net impact is about 13% for both. You can see that the positive impact is quite high, and then it has no negative impact because we make sure that we're not investing in negative impact within our portfolios. And then its benchmark on the right is has a net impact of minus 2.4. So it actually has more negative impact than positive impact. And then the real all-star within our funds when it comes to impact is our high impact equity fund. So this is a fund where we're trying to maximize the amount of impact while also meeting financial goals at the same time. So here the overall net impact score is 53.4. So that means on average within the portfolio, about 53% of revenue is coming from high impact activities that's contributing towards at least one sustainable development goal. And this is much higher than its benchmark, MSCI World, that has a net impact of under 2. So now that we know the overall net impact of these funds, we can dive into some of the companies that are within these funds. So within our high impact and our fossil-free Can Globe and fossil-free dividend, we have some of these companies, and we have the SDGs for these companies, the sustainable development goals above these company names. So within the good health and well-being sustainable development goal, we have companies like Vertex and Amgen. These are biotech companies that are providing solutions to some of the biggest diseases around the world. Within affordable and clean energy, we have Enphase and SMA Solar. Within sustainable cities, we have Vicinity Centers and RioCan. These companies construct green buildings as part of their overall portfolios. And then within responsible consumption and production, we have Citrix Systems and Acuity Brands. These companies create technology or equipment that helps people with energy efficiency. So these are just a few examples of what we have in the portfolios. Within our impact portfolio, we have about 30 to 40 different high impact companies. And then within our fossil-free Can Globe and fossil-free dividend, we have about 60 to 80 companies. So these are just a few samples of what we have. And if we dive more into Enphase Energy, one company that we've been investing in a fair amount in the last couple of months within a lot of our funds, it has a high net impact ranking, but then it also has a high financial ranking within our quantitative models. So Enphase Energy focuses on residential solar primarily. So they manufacture and they supply inverters for solar systems. They supply batteries. They supply EV chargers now actually too. And then they also create software that connects all of this solar equipment with the solar panels. And provides reporting for homeowners as well. So this has a large amount of impact. If you look at the net impact score for this company, it would be 100%, because 100% of its revenue is coming from high impact activities that are contributing towards the sustainable development goals. So a quick look at some stats. It's creating a lot of clean energy. So about 11 billion kilowatt hours in the last year in clean energy. And then in terms of CO2 that's been offset or eliminated, since its inception, it's offset or eliminated 31 million metric tons of CO2. So massive amounts of impact there for Enphase Energy. Now, a question that we often get from clients is not only what's in the portfolio, but why do we not have certain companies in the portfolio? Clients will see companies that are very high impact, that are doing great things for the world, and wonder why it's not a part of the portfolio. And so one of these companies in the past 12 months has been Rivian. So Rivian is an electric vehicle maker. They're an innovator. They're really moving forward EV technology. Right now, they're rolling out some of the EVs. They're not manufacturing en masse yet, but they soon will be. And so soon they're going to be convincing car buyers to buy EVs rather than internal combustion engine vehicles. And so that will be mitigating a lot of CO2 emissions. So a lot of impact there. So when we are looking at companies to invest in, there's two main areas that we need to focus on. One of them is values and impact that company is making. We want to make sure that it's aligned with client values. But then the second area is we want to make sure that it has a good risk-adjusted return, or at least a good risk-adjusted return potential. And so this is because our clients want to invest in a values-based way, but they also need to be saving for retirement. They want to be saving for travel. They want to be saving for inheritances, whatever it might be. Typically, clients don't just want to be making impact. They want to be doing both of those things. So within our funds, we're focusing on both. So in order to make it into our portfolios, you need to be passing all of those screens that we talked about before, all of those positive and negative screens. And then you also need to have a high ranking within our financial models. Then we'll put you in, then we'll put that stock within the funds, because we believe that we can do values-based investing and have good returns at the same time. So in Rivian's case, it passed all of the sustainability screens, the impact screens, but it had a really low ranking within our financial models. And at the beginning, when it first IPO'd, it didn't have any ranking in our financial models because there wasn't enough data. And we're not comfortable taking a big risk with client money with companies that we don't even have a financial ranking for. And so we stay with our systematic approach, and we're really glad we stay with our systematic approach, especially when it comes to a company like Rivian that went from $100 at its IPO down to about $20 and now has bounced back up to about $38. So possibly in the future, Rivian will have a good financial score within our models and will pass our sustainability screens. But for right now, it doesn't have a great overall score. So that's why we don't invest in Rivian. So I believe that concludes our section on the values-based investing process. And now we can move on to Q&A.
Thanks, Mike. So I really like the conversation about Rivian. I think it answers a lot of questions for clients. And speaking about performance, maybe you can just make a quick comment about how our funds have done versus the benchmark.
Sure. Yeah. So we have our flagship fossil-free fund, which is our fossil-free Can Globe fund, has been running for about 9 years now, and that fund has beaten its benchmark on average per year, and so it's performed just as well as our other funds that are non-fossil free. So it's been a strong performer, and we believe that over the long run, companies that are providing solutions to some of the big problems in the world are going to be able to perform well. And we've also done back tests. So we've done back tests looking back about 21, 22 years now, looking at how well a fossil-free approach would have done over the past 21 or 22 years. And we found that investing fossil-free over that time period would have actually outperformed the index. And the index, of course, includes fossil fuels.
Great.
So we're quite confident that you don't need to have fossil fuels over the long run to have good performance. Of course, there's going to be short-term swings. Sometimes areas of the market like renewable energy will do extremely well. So then maybe our impact fund will do really well. And sometimes there'll be spikes in oil prices like there has been in the past couple of years. And that will mean that these funds probably won't do as well in the short run. But if we're investing with our values and investing with the long run, we believe that we can get performance and invest with values.
Great, thanks for that. And just looking at the questions, there still seems to be some questions around the bank, holding banks. So maybe you could just reiterate our view on that.
Sure. Yeah. So banks are a tricky one because, like I was saying before, they have the choice who to lend to. So they can lend to companies that are providing solutions to climate action, and they can lend to companies that are negatively impacting climate change. And so when we're looking at banks, we are very strict on the overall screening of banks. So we're actually more strict with banks than with other companies. So we're making sure that there are not only not severe and widespread controversies around the environment, but even moderate controversies. We're making sure that we cut out banks that are involved in those. So we do have a list of banks that we actually don't invest in. And then when we do invest in banks, we're making sure that we engage, especially Canadian banks. That's a big part of what we do. And banks, so if you're investing in Canada and you're not investing in oil and gas, it's very hard to have a well-balanced portfolio and not invest in financials too. So we have decided within our funds to be investing in banks, but engage them and try and make them better and better over the long run. And we have been able to do that with engagement. So we know that engagement is effective, and we think that they are improving.
Great, thanks for that. Okay, so far we've been talking about publicly traded companies, but there is a question from Nancy on how to support new companies who are innovators, so early public companies who are proactively leading climate solutions. So how would one go about doing that?
So at Genus, we have an investment program, I guess you could call it, or part of our investment part of our investment process where it's called the Impact Investment Council. And so within the Impact Investment Council, we're investing in funds and products that hold companies that are in their early stages. So these could be technology companies that are focusing on clean technology. This could be infrastructure around renewable energy. And so in that part of our business, we're focusing on these private businesses that are typically quite new and providing a lot of new innovation. So that's one area. And then when it comes to small publicly traded companies, we typically don't invest in small publicly traded companies. We invest in more large cap companies that are making a lot of impact. So that is one area that we don't have many investments in, just because we don't believe that we can build financial models that can be as successful in those kind of smaller arenas. But there is a lot of impact there.
Okay, thanks. And here's a question from Walter. He wants to know if economic or political conditions sometimes make values-based investing moot.
Well, I think investing with your values is always very important, no matter what the economic and political situation is. Those are your values, so you want to be living out your values in your daily activities, in the work that you do, but then also your investments. So I think no matter what's happening in the world, I think you want to stick with your core principles, your core values as a person. In terms of effectiveness of values-based investing, in terms of creating kind of market change with your investment style, I think that it can vary based on what's happening politically, what's happening economically. I think some of the biggest reasons why you want to be values-based investing, besides just investing with your own core principles, is that it can send a signal to the market that you don't stand for a certain practice. And that signal can also encourage other people to decide to invest with their values as well. Maybe that means divesting from a certain area. Maybe that means investing and engaging a certain group of companies. And it also can change cost of capital for certain companies. So if there's a big support for a certain climate solution, a lot of people want to invest in that climate solution, then companies that are focusing on that solution will be able to get capital at a cheaper rate. The same thing happens on the other side. If a lot of people don't want to invest in a certain industry, then it's going to be much harder for companies in that industry to get capital at a lower rate. So it's going to make it so that they don't want to invest in as many projects if they can't get that capital. So I think overall political and economic situations can make values-based investing more or less effective in causing change, but I don't think that should determine whether you do values-based investing or not, because your values should be your values that are core to you.
Okay, thanks, Mike. And we have time, I think, just for one more question. And I think this is a great question that nobody really asks about is, our data. So how do we make sure that our data is reliable?
Yeah, so at Genus, we're a quantitative firm. So that means that we take in massive amounts of data and put them into our models. And those models then determine what we invest in from a financial perspective. And then it also helps us determine which companies are aligned with values or not. And so the way that we make sure that this data is reliable is that we have multiple data sources. So when it comes to sustainable data, we have 3 different providers, and we're always looking for other providers as well. And we're cross-checking these providers. So if one says that a company is okay, but the other says that a company isn't okay, then we'll either look into it or we'll take the more conservative approach and not invest in that company. And so we're cross-checking when it comes to financial data as well. So it's just, I think the key is just not relying on one source, and then if something seems strange, then looking into it.
Right, and the other thing is we're collecting third-party data as well. So this is not, primarily our own internal data that we're looking at. We're looking at other sources and collecting a lot of different sources of information and looking at it. Okay, so I think we're going to have to end it here with the questions. So thank you, everybody, for joining us today. And while we understand everyone's investment journey and particularly their values and priorities are unique, we hope that we provided some key takeaways for you. So we have 2 upcoming events that I'd like to bring your attention to. So Rise and Shine Meetup Series, I'd like to invite those of you who consider yourself an impact investor to join us at a networking event. And we're hosting for Vancouver-based impact investors on September 27th on the rooftop of our office. So this event is co-hosted with Impact United, and we're very excited to offer it to you. And you can use the link in the chat to register. So just a note that there is limited seating for this event. And if you're interested in attending, please sign up as soon as you can. And our next webinar, which is coming up on October 20th, is hosted by Genus Portfolio Manager Ian Lusher. And the topic will be investing in turbulent times. So safe to say that we will continue to be in turbulent times next month, unfortunately. So if you'd like some tips on weathering the storm effectively, please use the link in the chat below or in the chat to register. And the invitation will also be sent to everybody at a later date as well. So again, that's all we have time for today. But for those of you whose questions we didn't get to, we will do our best to give you answers directly from someone on our team, and just as long as you have provided us with your name and contact number or contact information. And Mike and I want to express our gratitude for all of you for taking the time today to attend our webinar, both our valued clients and for those who are new to Genus. And if you're new to Genus and you're inspired to take this conversation further with one of our portfolio managers, again, you can reach out to one of us via the team page on our website at genuscap.com. I'd also like to thank the team at Genus who work behind the scenes to produce these webinars. It does take a village. And a recording of today's webinar will be provided to you as well via email, and it will also appear on our website in the next few days in case you want to revisit or share with your friends and family. And we're also going to include a link to any resources in a follow-up email as well. And lastly, if you can please stick around for a few more seconds as soon as we close the session, you're going to be redirected to a survey, and we'd love to hear your thoughts and feedback. So thanks again, everyone, and have a great day.
Thank you.